You can see on the screen in front of you there, two profit and loss statements. I've left the revenue out, but the expense component of two profit and loss statements. Now, I don't know if you can see there, but both of those are in alphabetical order. Start at A and go down to, on the left, from accounting down to wages, and on the other one goes from accounting down to travel and US expenses. And you can see in there, in one there on the right, it's got $4 million worth of employment expenses, and one on the left's got $300,000 worth of wages. But I believe that this traditional profit and loss, which most people get from their bookkeeper and accountant, is utterly useless to manage a business. I'm going to tell you, as an accountant for 30 years who's been trained to do this stuff, that the profit and loss that most accountants and bookkeepers give you, you need to throw in the bin. That's right, throw it in the bin. So what do you replace it with? You need to start thinking about your business and your cost in activities, and you need to start looking at your key performance indicators. So I use the analogy of buckets. Start thinking in buckets. And the typical buckets I see in a business: a bucket for acquisition, all the costs you incur to get customers. Direct cost of sales. For example, if you sell a product, all the costs you have to warehouse the product, to ship it out to customers. Retention, that relates to all the costs that you incur to actually keep a customer, and overheads. Now, there's probably a couple other buckets floating through there, but they're the typical ones I see. And if I talk about salaries and wages, you could have in your staff costs a salesperson who goes out and wins your new business. You could have a warehouse person who ships the goods. You could have a customer service person or an account manager who helps you retain customers, and you could have someone in accounts paying the bill. Those four people, their expenses in most profit and loss sits in a line called salaries and wages. But you really need to understand, where do they relate, what part of your business, what activity in your business are they related to? Are they acquisition, direct cost of sales? And the other thing about these buckets, you may need sub-buckets or mini buckets. For example, you may want to split your stuff between different product or product groups. You may have part of your business where you're doing it through an indirect sales channel and through a direct sales channel. You may be doing stuff in different states or different locations, and you need to understand that. So you may actually have multiple different buckets within buckets. But you need, as a business owner, to start thinking about what your buckets are and whether you need sub-buckets. I'm going to show you now how this really helps you understand your business. I've put up on the screen here a profit and loss statement done in the old traditional way. You can look at that and you go, I've got one variance for $1,000. That profit and loss looks pretty good. As an owner, is there anything there I need to focus on? Maybe postage. But let's have a look at this profit and loss statement broken up into the buckets. So I'm going to break it now into direct cost of sales, retention cost, acquisition cost, and overheads. Suddenly you can start to see a whole lot more into your business. Let's have a look at revenue, for example. Revenue is in line with budget, but looking at the real numbers or the breakdown, I can see that my gross revenue is above budget, but I'm giving away more discounts. Is that a problem in my business in terms of what I'm planning to do for discounts? Is that something, as a business owner, I need to look at? I have a further look to it. I've paid commissions on direct cost of sales. So I'm selling more stuff through an indirect sales channel than through a direct sales channel than I planned. Is that a problem for my business? Do I need to have a look at that? I have a look at my marketing. I've overspent on retention marketing. But on the other side of the coin, I've underspent on acquisition marketing. Now, the cynic in me might say, well, the marketing person realised we're overspending in one area, so underspend on another area to balance it out and to hide it. But here's a question for you. Is underspending on acquisition marketing and paying less for acquisition commissions a problem? Does that mean that all my projected growth in the future is not going to happen? Is that something I'd like to know about today, particularly if I'm planning to bring on staff to meet that future growth, and I'm going to have all that cash costs when in actual fact I don't have any growth in revenue? So looking at this P&L, I've picked out about 5 or 6 different business issues that this previous P&L didn't show. And the only way I could see that is because I broke my costs down. And it makes people, when they're spending money, for example, marketing, what are you spending it on? Are you spending it on retention or acquisition? To make people think about what they're spending rather than just spending it through the process. What I'd say to you is that you need to understand what buckets your costs are incurred in. You need to understand your activities, and you need to understand whether you have any sub-buckets through the process. Because once you do this, you can do the next part of the process, which is actually start to implement some KPI reporting. We want to get some really important metrics that every business owner should understand about their business. The first one I want to talk about starts with monthly contribution. That's revenue less direct cost of sales, any retention costs, and fixed costs. Now, I said contribution, not gross margin. Really important. So that's one of the reasons why you need buckets, because you can understand what's in retention and go from there. Once you understand your monthly contribution, you need to understand how long you keep a customer. Once you know that, you can get the lifetime value of your customer. You now know what a customer is worth to you. Wouldn't you agree that's something really important that every business owner should know? What a customer is actually worth to them. So that's one of the metrics that most business owners don't understand, but it's really important. And this is where it gets even more important. The next metric you need to understand is how much it costs you to get a customer. What you spend on acquisition costs divided by the number of new customers gives you your acquisition cost per customer. If you don't have your acquisition costs broken out into the bucket, how do you work this out? Because this is where these two metrics come together. If the lifetime value of your customer is higher than the acquisition cost per customer, you have profitable growth. If the acquisition cost is more than the lifetime value of your customer, you have unprofitable growth. So if you're doing that, you're just turbocharging yourself to going broke. And the only way you can work out these two metrics and work out whether you're growing profitably or unprofitably is you need to put your cost in buckets. You need to know what your acquisition costs are. You need to know what your customer contribution is. And you need to know how long you keep a customer. Once you understand those metrics, you can work out whether you're growing profitably or not. Really, really important. And unfortunately, I see far too many businesses that don't do this. So let's have a look at that last example, and we're going to put some KPIs against that. So let's have a look here. Now, our revenue is up, but our contribution's down. So we've already talked about that being a potential problem for the business. We've got less customers than we planned, so our average revenue per customer is up. That's a plus. But our contribution per customer is down. A concern. Our customer life is up, but even though our customer life is up, our lifetime value of our customer is actually down below budget. That's a red flag as a business owner or as a business manager. You need to think about what are we going to do to get the lifetime value of our customer, particularly as it's now costing us $169 to get a customer versus $100. So putting that another way, when we budgeted this, we expected it would take 2.5 months to get our acquisition cost back. It's now taking us 5 months, twice as long. So think about the cash flow requirements here. This is just an example for some numbers, but that's why you need to understand your buckets, your KPIs, and what this means for your cash flow. In this particular business, if it's going to take 5 months to get your acquisition costs back, you're funding the cash drain for 5 months. So you need to be aware of that, and you don't want to start growing your customers and find you don't have enough cash to fund that for that process. I'm going to give you a couple of examples. So let's use Curb. I don't know how many people know about Curb, but they basically, and we'll do some simple examples, they rent out parking spots around the city. Here's an example here, one in King's Cross. You got free parking spots, where you live, and you want to rent them out, you go through Curb. In this example here, it's $20 for a day, and Curb would take a 20% commission on that, so they'd make $4. One of the things Curb did a while ago is it went round and put some fake parking tickets on the windows of cars, for example, around Woolloomooloo or Pyrmont. And it looked like a parking ticket, and it basically was a bit of a joke. It said, you know, be thankful this is not a parking ticket, and if you want to avoid the risk of getting a parking ticket, here's a $10 voucher to use our service. So basically it was a $10 voucher. Now, if someone used their service and only parked one day, they'd pay out $10 to get back $4. So that's unprofitable growth. If someone parked for, say, 5 days, they're going to get in $20 and pay out $10, so that's profitable growth. So for someone like Curb offering that sort of marketing deal, they need to understand what they're spending on getting a customer and how long a customer's staying. If a customer's only using the service once and leaving, is it worthwhile to continue offering that $10 voucher? No, it's not. If the customer's coming on board and booking for 3 or 4 months, maybe they can offer something a bit more to grow their business. But unless they understand their acquisition costs and how long their customers are staying with them, they can't do that metric. Here's another example. Prepaid SIM plan, $40 a month. Let's say that the contribution per month's $5 and the average life of a customer is 10 months. So $50 is break even. But what happens if the business is spending $60 to get that customer that's worth $50? If they have the metrics to do this and understand that they're spending $60 to get $50, they can make strategic business decisions. Do they do something to increase the monthly contribution above $5 a month? Maybe reduce the costs, maybe do something to get the customer to spend more? Do they do something to increase the life of the customer beyond 10 months? Or do they reduce their acquisition spend? Or they do a combination of all of those? The key thing here is, without knowing that you're currently spending $60 to get a customer worth $50, you can't make the right strategic business decision. I've seen this where people are doing these sorts of numbers in various businesses, and all they're doing is adding more and more unprofitable customers, and they wonder why their cash flow is not improving. They wonder why their bottom line is not improving over the long term. And this is why, because they don't understand what they're spending to get a customer, and they're bringing on unprofitable growth. So, and you can only do this when you start breaking stuff into buckets. Throw out your old profit and loss. Put your cost in buckets. Start measuring KPIs. Then you can really understand the real drives for your business. And as a business owner, you can start to make strategic business decisions about what you need to do. Otherwise, if you're flying blind, you may be, in this case here, happy to spend $60, not realizing that it's sending you broke through the process. And that's why I say to people, the buckets, the bucket concept, understanding those key, particularly those key KPIs, of the lifetime value of your customer and the acquisition cost of your customer, and measuring those is how you can make sure you're making the right strategic decisions for your business.